All right. Good morning, everyone. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's 10:03 a.m. Pacific, April 4th, 2025. Gonna start this with a reading from an old poem. April is the cruelest month. Definitely a rough start to April, and what was marketed as Liberation Day has been quite a shock to asset markets across the globe. We've seen repricing in equities, repricing in rates, and repricing in commodities. Pretty dramatic moves. So we're just going to jump in there and kind of give you guys an update on where things stand as of the recording of this podcast. I don't think it's going to make sense to go into the March and Q1 numbers because of the massive moves that have happened from April 2nd to today. So we're just going to talk about the year-to-date performance and week-to-date performance, because I think that's what's meaningful right now, given the big moves. So kind of looking at things on a week-to-date basis, let me just take a peek. I mean, the S&P 500 is down about 8%. As we're sitting here right now, the S&P 500 is down 250 points today, down 4.6%. So pretty big sell-off there. That leaves the S&P down 12% on the year. And then looking at more of the high-flying sectors, technology is down 20% on the year in a bear market. So the S&P 500 is in a correction. The technology sector's in a bear market. On a week-to-date basis, the tech sector's down 10.5%. Another big loser week-to-date is the energy sector, down 13%. And you can see that in crude oil prices. As we're recording right now, WTI crude's trading at $62. Brent crude's trading at $65.5, down about $10 from where they were starting the week. So pretty big moves in the energy space. And
So thanks, OPEC.
yeah, that move was a combination. It was like a double whammy.
Yeah.
Okay, good point, Mark. It wasn't just the Liberation Day tariff announcements. It was the decision by OPEC to actually increase production and kind of flood the market a little bit. They're going to increase production by about 500,000 barrels. And, it's a pretty interesting concept to, when you couple that with lower growth expectations, this is what you get. You get a big repricing in energy markets. But, as professional investors, we have to keep a cool head. We have to kind of look at things with a rational point of view. So we're not going to get too shocked by these major repricings. But, we kind of have to just look at the prices as, what is the market telling us? Well, the market's telling us uncertainty is high, and there's been a major shift from the Liberation Day tariff announcement. So kind of jumping back into U.S. equities, when you look at some of the other sectors that really took it on the chin, I think that those two popped out, tech and energy, but communication services is also down about 8% on the week, putting it down about 8.5% on the year. So that's another one. Consumer discretionary, a big loser year to date, down 17%, and it's down 6% on the week. Kind of, what are the bright spots? Well, unfortunately, every sector's negative, but the least negative, I guess you could say, this week is the healthcare sector, down about 5%, and year to date, it's actually up 14 basis points. Utilities also down 3% on the week, up about 30 bips on the year. And those are some interesting things. Consumer staples, another spot. This is the best performer on the week, which, as you might expect, it's down only 1%. And on the year, it's actually up 2%. So some interesting kind of divergence there in equity prices, kind of drilling in and looking at small caps. When you look at the Russell 2000 is down 10% this week, and it leaves it down 18.5% on the year. So not a bear market in small caps yet, but heading in that direction. The when you look at growth versus value, interestingly, on the week, there isn't much of a divergence in the performance of those. The Russell 1000 growth is down 8.5. The Russell 1000 value is down 7.5. So value is outperforming, but where you really see the stark differences in the year-to-date performance, where the Russell 1000 growth is down 17.5% and the Russell 1000 value is down 6%. So pretty big outperformance of value on a year-to-date basis. And as we see this repricing, there's just a pretty interesting situation going on where people, market participants, are just having to rethink a lot of things. And frankly, here's another interesting point that we saw an inversion of the VIX curve, which means the short-term VIX is higher than long-term VIX, which you often see that kind of VIX backwardation. And in these crisis moments where people are panicking and they're just hitting the sell button. And I think VIX is one of those indicators that's just showing you that there's massive fear right now. VIX is at 40, which is clearly in the fear kind of area. And I think that investors are just trying to discern what the future holds because no one really knows. I mean, Chair Powell was up there giving a speech today, and he took the stoic path of, wait and see, sit on his hands. I mean, I find it a bit interesting that he says that, but the market is kind of calling his bluff a little bit. The market is really expecting a cut coming in June. In May, there isn't a huge probability of a cut priced in yet, but it's looking at one in June. But let's not get ahead of ourselves. I just think that in these times where you see big changes in asset prices, you have to sit back and you have to evaluate and think, okay, is this oversold? Is this irrational? Is this fairly priced now? Or is this undersold, and maybe there's some room for it to go until the market reaches a clearing level. And so that's kind of, I think, where the market is right now, trying to really evaluate the longer term consequences of these tariffs, because it doesn't seem like the tariffs that were announced are likely to be removed easily or quickly. At least that's my interpretation as of the recording of this podcast. And we had some interesting charts going around the desk yesterday suggesting that these tariffs that got implemented, there are a massive increase in the effective tariff rate. I mean, there's no other way to say it. It's really a kind of a paradigm shift. And I'm not just saying that for hyperbole. That I think this truly is a different global trade regime. And so I think investors and market participants and people around the globe are going to have to really think, about consumption decisions and investment decisions given this new reality. So kind of, it isn't all doom and gloom though. One very interesting thing is, if you're a fixed income investor, you got rewarded for owning fixed income this week. Bonds on the week have performed quite nicely. So that's one area where investors, if you were hedging your bet, so to speak, and you had some ballast in your portfolio, we've seen a nice performance. The U.S. aggregate's up about 1.5% on the week. Kind of looking at the yield curve, you saw a big drop in rates. You saw the 30-year drop 27 bips, the 10-year drop 32 bips. As we're recording right now, the U.S. 10-year Treasury rate's at 3.93%, so well below that 4% level. The 30 years at 4.36%. And you saw the front end of the curve kind of drop in as well quite dramatically. So the 2-year Treasury dropped 31 basis points. As we're recording this podcast, the 2-year Treasury is trading at 3.6%. So big moves in fixed income in the Treasury curve. The front end still pinned higher because the Federal Reserve hasn't adjusted monetary policy, but it just, if you look at the tea leaves, it would seem that the Federal Reserve is likely to start cutting rates this year 1 to 2 times at minimum. And if a recession hits, they're definitely going to cut more than that. So, you can't overreact to the data, but kind of in fixed income land, the best performing sectors, as you would expect, are governments up 1.8%, mortgage-backed securities up 1.5%, and high yield investment grade corporate bonds, which are up about 80 basis points, 80 to 90 basis points. And, they have a lot of interest rate exposure. Those cash flows have what in fixed income we call duration, which means they come farther in the future. And so they're more sensitive to interest rate conditions. So they perform well. The credit sectors of the market, on the other hand, are selling off, as you would expect, with high yield bonds down about 2.3%, bank loans down 2.1%, and emerging market bonds down about 1%. And that leaves the fixed income land on a year-to-date basis. The U.S. aggregate's up 4%. Government bonds are up about 4.5%. Mortgage-backed securities are up about 4.5%. And investment-grade corporate bonds are up about 3%. Looking at other sectors of fixed income, high yield, it's down about 1% on the year. Bank loans down about 1% on the year. And emerging markets still hanging in there, up about 1%. So, fixed income has been a diversifier, and it's done its job. It's kind of kept your portfolio from being blood red. And so I think that, everybody who said that bonds were finished forever, I think that this is a scenario where you could say, okay, this is interesting. This is why you own bonds. Now, kind of rounding out with commodities, I mean, it's been a bloodbath, to be quite frank. The Bloomberg Commodity Index is down 5.5% on a week-to-date basis, and the energy sector is down 8%. Industrial metals are down 10%. Copper's really taking on the chin. Copper's down 14% week to date. But interestingly, year to date, copper's still up 9.5%. So keep that in your brain. Gold, another loser this week, interestingly. It's trading around $3,000 an ounce. So it's dropped pretty considerably from $3,027 as we record this. Considerably from the highs it reached just a week ago. But, on a year-to-date basis, gold's still up 14%. So still shiny on pet rock land. Bitcoin down 1% on the week, down 11% on the year. So I think that kind of the dollar, another loser, down 1% this week and down 5% on the year. So that kind of rounds out the market. As we just discussed, equities, it's all red over there. We're in a bear market in technology. We're in a correction in broad stock market. Energy's getting hit pretty hard. Commodities, though, are still positive on the year, up 2%. So keep that in mind. And bonds are doing their job. That's kind of my roundup for the week regarding the markets. But interestingly, we got some when you look at the macro data, it's not all negative, right, Mr. Kimbrough?
Yeah, this was the macro data strongly contrasts with the the market data this week. I mean, it's as you mentioned, the diversification was working this week, but still a pretty bloody week. But yeah, let's jump into the week. We start off. This is Jobs Friday. It's Labor Week. We start off on Tuesday with the JOLTS data for the month of February. This printed at 7.568 million. That was 90K below the estimates, 194K below the prior. I'm gonna give you a little context for this print because we've been seeing a little stabilization in some of these labor metrics. There's long-term downtrends, but let me give you a couple stats here. With a 12-month moving average of JOLTS, it's been in decline for 31 consecutive months and continues to be. It was coming off a very high level when the market was extremely tight, but we know we've been dealing with when the market was loose, we've been dealing with a tightening labor market. In contrast to that longer-term 12-month moving average, the 6-month moving average actually rose for 3 of the last 4 months. From November to January, the 6-month moving average rose. This month, unfortunately, that streak was snapped. But what this is showing is that long-term downtrend, is still intact, but there's attempts at stabilization here. Looking under the hood, I mean, that's actually a lot of the trend I'm seeing. If you look at the different rates that this report contains, the hires rate, the separations rate, and the quits rate, those are all, let's say for the hires rate, for example, it's the total number of people hired as a relative portion of the total number of employed folks. And all 3 of those rates are exactly where they were last month. They're actually all right in line with what their 12-month moving average would be. And they're all a little worse than they were a year ago. So that shows you that, hey, on trend, yeah, we've gotten worse, but there are attempts at trying to stabilize this labor market, at least through February. And I'll get into the March data. This is very far in the rearview mirror, so you can't hang your hat too heavily on that. But
Yeah,
yeah, not a
that
bad
that's
report.
that's one of the when you have such a big momentous thing like what happened on April 2nd, where you had a real regime shift. Some of this data, which, like you're mentioning, is somewhat sanguine from March. I don't know how relevant it is going forward, but I do think it's important that we go through it because it's easy to get caught up in the cycle of fear by just saying, "Oh, everything's dropping," and all you see is red on your screen. But the fundamentals were pretty solid to start. So, yeah, I think we just need to keep that in mind.
Yeah, look, as we progress through all this, one of the things that's going to matter, like the tariffs are shocking the world right now. But one of the things the US has had going for it has been this resilient labor market. And the resilience that's maintained through March, we'll see how far that goes in terms of giving us a little cushion, a little runway as we deal with whatever we're going to be digesting over the month, year to come, and longer, seeing how long this all lasts. So, and yeah, exactly as you said, this is why we're still going through the data. You can't, it, March feels like ages ago, but it still is what it is. So
Well, it was only 4 days ago is
it,
what
it
it
feels
was.
like it feels like a year ago. There's been so much that's occurred. This was hell of a week. But also on Tuesday we got ISM manufacturing for the month of March. This printed at 49.0. That was zero point 0.5 below the estimates, 1.3 below the prior. Like I've been talking about this for the last few months. There's been a lot of volatility in this data. Unfortunately, this is lining up with S&P Global, where we had a 2-month streak of expansion that was snapped for the month of March. So undid a little bit of the hope that emerged. I'm not going to dig too deep into these numbers. We kind of had a little zigging and zagging on the ISM manufacturing. But this was just in general not a strong report, and that's just kind of continued. The winter for manufacturing continues. On Wednesday, we got the ADP employment change for the month of March. This printed 155K. It's 35K above the estimates and 71K above the prior. Another report. I'm not going to dig too deep into this. I want to look forward to the Friday stuff that was released today. But I'm going to give you a little quote of optimism from the chief economist at the ADP. This is, quote, "Despite policy uncertainty and downbeat consumers, the bottom line is this. The March top line number was a good one for the economy and employers of all sizes, if not necessarily all sectors." End quote. So again, a little through March, if you just looked at this data, we'd be feeling a little better. But that's not dealing with the tariff consequences. On Thursday, we got the Challenger job cuts year over year. Not a number I'm usually commenting on as much, but we had a bit of a spike over the last 2 months, so I figured it's worth getting a little clarification on that. The year over year number through March, these are job cut announcements, was up 204.8%. So that was versus a prior up year over year, 103.2%. That sounds eye-poppingly large. But one thing to mention, this most recent print we had, about 80% of the job cut announcements were coming from the government. The actual percentage of job cut announcements are basically right in line for the private sector, or right in line with where they've been for the last few years. It's on the upper end, but that is yet to break down. So, this is not good for the economy to have job cuts, period. I mean, just, people in the government losing their jobs would, it's not going to be economically beneficial, at least not right from the start. But you still have to deal with those numbers in the private sector. Still so far through March hanging in there. Again, we'll see how that develops. On Thursday, we got initial jobless claims for the week ending March 29th. Steady issue drifts here, 219K print, 6K below the estimate, 6K below the prior. Nothing to see there. The continuing claims, though, we did have a little pop-up for the week ending March 22nd. It printed at 1.903 million. That's 33K above the estimates, 56K above the prior. We're now above the 1.9 million watermark. Back in January, this actually touched 1.9 million, but it got revised away later on. So this is now, our first pop above since we've, escaped it from 2021. So we'll see how that continues to develop and if that's, the beginning of a new trend or not. Also on Thursday, we got ISM services for the month of March. This printed at 50.8. That was 2.1 points below the prior, and below the estimates, and 2.7 below the prior. To give a little deep dive into this one here. We're on a 9-month streak of expansion, although this print was a 9-month low. We had a couple dips, in April and June last year, slightly below 50. But looking under the hood of the actual numbers that are, that this is calculated off of, I want to focus on new orders, backlog of orders, business activity, production, and employment. So demand comes from, we have new orders, that's tip of the spear of demand. That printed at 50.4, still expansionary, but very mild. You have the backlog of orders. It printed 47.4. That's moved out of expansion back into contraction. It's actually been in contraction for 7 of the last 8 months. You have business activity and production that printed 55.9. That's a very firm expansion number, even if it's lower than we've been in recent years. That just speaks to the strength we've had in the services economy. And the employment number dipped strongly by 7.7 points to 46.2. It's actually the most contractionary print for services employment we've seen since December of 2023. So I want to wrap all those four together and say 2 months ago, we had just hit the backlog of orders contracting for 6 straight months. And your backlog, when your backlog is contracting and your demand is not filling up and your activity is running through that backlog, that's not exactly a sustainable combination forever. At some point, you need demand to pick up to, outpace your productivity or your activity, and that would help your backlog rise. Well, in preparation for this, kind of onslaught on the backlog, we've not seen 7 out of 8 months in contraction in a while. It's a number of years. You can prepare for that kind of need for a decrease in activity by cutting back on your employment. And that's exactly what we saw this month. Again, this is 1 month's worth of data. There's no guarantee this is the way it is. I'm trying to form a narrative around the data points that are provided. But this is showing, some signs of concern on the services side is what I'll mention. And yeah, we'll see how it continues to develop. Again, we've had a little volatility in the last few months, so we'll see how it goes. Closing up, we have Friday today, Jobs Friday. We have the change in non-farm payrolls for the month of March, printed at 228,000. That is 78K above estimates and 111K above the prior. That crushed all estimates. The highest estimate on the street was 200K. So, all else equal, this would have been a nice day for the employment report. We did have a 2-month net revision down
look,
of
the
48K
unemployment
though.
report, would have been a shining light if,
Yeah.
the tariff announcement hadn't been dropped on the second, but that's really overwhelming, this data now.
Oh, this is, again, it's in the rearview mirror. People are looking forward. The trailing data that, is in the past, we're living, as you said, it feels like a paradigm shift. This is, you can't take too much from the prior trends, it seems. At least you don't want to over extrapolate them. But again, I still want to speak that this is the ongoing resilience built into the economy. So we'll see how this helps to kind of, we'll see how much of a buffer this can be in terms of the headwinds to come. But in this report, you did have, private gains was 209K out of the 228K. That's better than we had a year ago. So again, strong month. You still have government jobs coming in at 19K. So again, for the establishment report, all in all, not a bad data set here. That brings us to the household data set. We have the U3 unemployment rate for the month of March. It printed at 4.2. That was 0.1 below above the estimates and the prior. You got the labor force participation rate that printed at 62.5%. That's 0.1% above estimates and the prior. And you got the underemployment rate, the U6 rate, that came in at 7.9%, improving from prior of 8. While the unemployment rate rose, we're going to try and give some specifics here. It's rounding. We had the prior was at 4.14. This month we got 4.15, and you caught the round up to 4.2. So not as drastic of a deterioration there as it would appear at the headline.
Yeah, that's people are like, oh, it's up by a tenth of a percent. No, it's up by a tenth of that. So it's kind of interesting.
And similar thing. It's on the labor force participation rate. In general, I'm going to always take the increasing participation rate as a positive sign. It's nice for people to be out there looking for jobs and wanting to work. And that number increased by 0.1. But that was another rounding situation. Prior was 62.44. It increased by 4 bips. We go to 62.48. There's your round. But look, looking under the hood for this data, you have the labor force growing faster than the population. That's why your labor force participation rate rises. You only had a small increase in the unemployed of 31K, increase of 201K for the employed. But I think one of the best details here was a little bit of a reversal of the pain from last month. We had the full-time jobs increasing by 459K, while part-time decreased by 44K. I know those don't net out the same. They're calculated differently, but it's nice to see a pickup in full-time jobs. That's, that is a positive in this report. And last positive point I'll mention is the part-time jobs for economic reasons. That's at 4.78 million. It decreased by 157,000 month over month. And you're not rooting for a decrease in part-time jobs, but when people are working part-time for economic reasons, it's nice to see that fall. And that wraps up the week. It's again, it already feels like it was a month ago, but that's what's in the rearview mirror.
Yeah, I think it's definitely important for investors to just kind of take a moment and really analyze the situation rationally and make composed decisions, especially in a time of flux, right, like this when there's a high amount of uncertainty. And so we'll kind of like let's just look at the interest rate probabilities, look at the kind of the futures market, see what the market's wanting from the Fed. Well, as we say here right now, the market wants 4 cuts this year. So clearly the market is in the recessionary camp. You know, if you look through December, the market's thinking there's going to be 4 cuts. Well, we heard Jay Powell speak today, and he he didn't want to admit that the Fed is in a tough spot, but he was kind of dancing around the fact that he expects inflation to be higher, and at the same time, he expects the economy to slow down, which would imply the labor market's going to deteriorate. And so, from the Fed's dual mandate perspective of maximum employment and price stability, he doesn't want to cut rates because he thinks that might increase inflation, especially if he expects a one off shock to inflation because of the tariff policies. But he also doesn't want to cut rates to stimulate the economy because he doesn't want inflation to get any wind at its back. So he's sitting on his hands right now, and I think the market's right in the sense that when you look at the probabilities, the market isn't expecting a cut in the May meeting, though the powers that be want there to be a cut. I'm going to steer clear of like discussing that kind of topic, but there's a lot of like political pressure on the Fed right now, to say the least, to cut interest rates. And I think the Fed wants to maintain its independence, and that desire is very strong. And the chair, Jerome Powell, is committed to that wholeheartedly and fully. So we're going to have to wait and see. But I think the Fed's going to sit on its hands in May and not do anything knee jerk unless we get some really massive data prints like the April employment report. But this tariff scenario, it's tough to see how it creates like massive employment shocks within the next month. You know, clearly it's going to be causing some big shocks to entrepreneur and business owner decisions on where they build things and where they supply parts from. So there's clearly going to be big implications, but
It's a
how
general sense of uncertainty that's just
yes,
floating out there. I mean,
correct.
it's
The
word
uncertainty is the
uncertainty.
main thing, which hurts business, right?
Yeah, you
Because
can't make
when you need to
decisions if you
make
don't know the future.
correct, and when you need to make business decisions, you need to have an understanding of what prices are, and then you have the understanding of the regulatory framework, and then you can make a decision where you're going to make something, what you're going to pay, what profit you're going to make. Well, all those dynamics are in a state of flux, and it's going to take some time to evaluate those things and make rational decisions for the future. But if tariffs aren't going to change, all things being equal, clearly goods that are coming into the U.S. are going to be taxed by the government, and somebody's going to have to pay the tax, whether it's the companies making those goods or whether it's the consumers or a little bit of both. It's that those are just facts from my point of view. So
That's big questions to see how
yeah,
that all settles out.
yep. And nobody has the answers right now. And this debate isn't going to be won out in people's mouths. It's going to be won out with spending habits and prices. And you just have to wait to see those adjustments come through in real time.
You
So
know what? I want to riff on that for a second. 'Cause this has been the weakening of the soft data that everyone's been talking about for months, and the hard data still remaining resilient. This is when the hard data is going to be put to that test, and we'll see how that in the months to come. It's finally this is a catalyst for the hard data to truly be challenged. It seems like.
yeah, I agree. And I think that I don't want to delve into the tariff stuff too much, but it's pressing. And I think that that's just um, something we should mention. So I got this table here that kind of shows the effective tariff rate change. And on average, the total average tariff rate went from, you know, it's tough to say right now, but the increase, on average, it increased by about 19%. So that's pretty big when you
Yeah.
look at it across the board. I mean, that's a significant increase. So if you're talking about a television that costs $1,000, that's imported, now it costs $1,200. I mean, it's definitely going to affect consumer decisions. When you're talking about, a car, a BMW, a Volkswagen, that now costs 20% more. Let's say somebody wants to buy a VW, and that thing, was 40 grand, which is like around the average price of a new car these days in the US. Well, now that thing is 48 grand. I mean, that's significant,
Yeah.
right? Like, people are going to see that, and they're going to adjust their spending habits accordingly, you
And
know?
that the adjustment's so necessary, and that's the important part is you look for substitute goods. I mean, that's the whole, maybe you try and buy domestic, maybe you can't. Maybe you just have to pay that higher price. But I mean, like the cars thing you mentioned, I mean, that knocks onto used cars. Maybe you don't get maybe you don't go for the new car. Maybe you get the used car instead. Even though that isn't tariffed, that price is still, there's still an increased demand for that used car, and you can have used car prices rise. I mean, it ripples through the economy.
Yeah, and because these tariffs are, being hit at different countries, it's going to have a different effect on different goods. It's not ubiquitous across the board. And so I think that's another thing. It's a very complex puzzle. And for example, okay, when you look at it, like the effective tariff rate on some countries is 10%. Like the United Arab Emirates, it's at 10%. The United Kingdom is, I believe, at 10%. But then you look at, for example, China, 34%, EU, 20%. Vietnam, one of the big losers in this whole tariff situation, they got jacked up to 46%. So those are big moves, for those goods. If you're an importer, and let's say you're bringing in, I don't know, textiles from Vietnam, and you're trying to sell them for $20 a shirt. Now they're $30 a shirt, or you were selling them for $30. Now they're $45. Who's going to pay $45 for a shirt? Nobody's going to do that. So I think that those are things that, like, there's going to have to be adjustments to the supply chain and to the profit margins of these businesses and to consumers' decisions. And that's a very complicated scenario that no economist can predict. And you're going to have to wait and see how things shake out. And that's kind of my point of view, is you have to stay rational, and you can't overreact to this headline shock, because it is a paradigm shift, and these are big changes, and prices and behavior need to adjust to them. And that's kind of where I'm going to leave it. I don't think that just going through this table and reading off every country is going to be super helpful to our listeners. And I just think that people need to be aware that this reality has shifted regarding global trade, and these are things that are going to have an impact on the price of goods in the marketplace. And so with that, unless you have anything else to add there, Kimbrough, let's jump on to the week ahead.
Yeah, let's jump ahead. Week ahead, we got it's a pretty light week, but it is inflation week. We got Monday, the consumer credit gets released. It's just nice to check in on the trends on revolving and non-revolving credit, see how credit card spending's going. On Tuesday, we get the NFIB Small Business Optimism Report for March. I didn't see an estimate at this time, but last print was 107. We've had a bit of a rally post-election, and it's been falling since December. Would be surprised if it didn't fall a little further, but we'll see what comes. On Thursday, you get CPI for the month of March. Headline month over month is estimated to come in at 0.1. That's 0.1 below the prior. The core version, ex food and energy, is estimated to come in at 0.3. It's also it's 0.1 above the prior. These would both boil down to bring the headline number year over year up to, bring it down to 2.6 versus a prior of 2.8. And the core number is estimated to come in at 3.0. That is a decrease of 0.1 from the prior. And this is just base effects. They're helping these small number or bigger number roll off, small numbers roll on. So we'll see how we get there. Also on Thursday, we get the initial jobless claims and continuing claims. No estimates, but we'll see if we still get steady as she drifts for initial and see what happens to continuing. And finally, on Friday, we get PPI for the month of March. We got estimates of 0.2 for the headline month over month versus a prior of 0, and the core ex food and energy estimated to come in at 0.3 versus a prior of negative 0.1. I believe the priors were 0.3s rolling off, so there's no estimates now, but we do expect a little bit of increase in the year-over-year numbers. And sorry, those were small numbers rolling off, so we expect a little increase. And that's all we got queued up for next week.
All right. Well, I think that wraps it up for this week. Thanks to our listeners out there for tuning in, and just keep a cool head and, think about these things rationalistically, and have a good weekend.
Yeah, thanks to our listeners out there. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yep. You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. Catch the latest interviews and episodes. I think Bill Campbell's actually going to be on Bloomberg TV today, so check out his commentary and check out any of the content up there. Always some good content.
Yeah, sure. And thanks everyone out there. Stay safe and good luck.